Think you're making too much money to fund a Roth IRA? Think again. Here are some legal strategies the affluent use to grow tax-free wealth. Welcome everyone. I'm Gabe Velez, CPA and partner at Tirani & Velez. And today we're going to be discussing Roth strategies so that you can lock in a low tax rate and never have to pay tax again. Let's start with the benefits. Roth accounts are powerful because they grow tax-free and distribute tax-free at retirement. You've already paid tax on the seed, the contribution. The harvest, the growth, is yours tax-free. Also, unlike traditional IRAs, Roth IRAs have no required minimum distributions, or RMDs. That gives you flexibility in retirement. We can't control the economy, inflation, or what Congress does with tax rates. But with the Roth IRA, we can control when we pay the tax, and that matters. Now here's the challenge. If you're a high income earner, you may be phased out from making direct Roth IRA contributions. For 2024, the income phase out ranges are between $150,000 and $165,000 for single, and between $236,000 and $246,000 for married couples filing joint. If you earn above these thresholds, you can't contribute directly, but don't worry, there are still perfectly legal ways to get money into a Roth IRA. Let's explore them. One key strategy is called tax bracket straddling. This is where we break the tax brackets into 3.5 zones and analyze them. For instance, I like to say the green zone is between 0% and 12% in the tax brackets. This is a no-brainer. Just pay the tax and let it grow tax-free and lock in that low tax rate. Then we have the yellow zone, which is 22 to 24% tax bracket. For me, this is the maybe zone. It really depends on your income trajectory and what your average income is and has been in the past. Next, we have the red zone. This is 32% and higher. Now, if you've maxed out all other strategies, a Roth might still make sense, but with caution. And then we have this little sliver, which is the additional half. This is the dark red zone. For me, this is where the marriage penalty comes into effect. So right around the 35% tax bracket, you're actually paying more tax as a married couple filing joint than your single counterparts. So anyways, the key is tax bracket straddling, optimizing conversions and contributions to stay within a tax efficient range and to look holistically over all of your earning years, past, present, and future. The Roth conversion is one of the most flexible tools we have. Here's how it works. You move money from a traditional IRA or 401k into a Roth IRA. You will pay the tax on the converted amount, but if you're in a lower tax year or can offset that income, it's often worth it. Here's a pro tip. Use outside funds to pay the tax bill. That way, all of the converted amounts grow tax-free. Also, there is no income limit on a Roth conversion, so anyone can do it. So let's say you don't have any funds in a traditional IRA. Well, you can do what's called a backdoor Roth. This is a two-step process and a workaround for high income earners. You first contribute your funds into a non-deductible traditional IRA, then you convert that into a Roth IRA. If done quickly, there's little to no gain to tax. So here are two caveats with the backdoor strategy. Number one is the pro rata rule. The IRS treats all of your IRAs as one when calculating tax. So if you already have a large pre-tax IRA, the converted amount might be partially taxable. Number two is timing. Convert quickly after funding your non-deductible IRA in order to minimize taxable gains. If you have an existing pre-tax IRA, you may want to roll them into a 401k first, if allowed to, in order to sidestep that pro rata rule. The next way to fund a Roth account is through a Roth 401k. Many employers offer these, and if you're a small business owner and you have a 401k, your TPA probably allows it too. The employee contribution limit is $23,500 with a $7,500 catch-up for if you're over the age of 50. And the best thing is there's no income cap. These contributions go in post-tax and grow tax-free. If your employer offers a Roth 401k, use it. It's a fantastic tool. Now let's go bigger, the mega backdoor Roth. Some 401k plans allow after-tax contributions up to the total defined contribution limit of $70,000 for 2025. If your employer allows it, you can make these after-tax contributions and then roll them into a Roth 401k or Roth IRA. This strategy is less common amongst small business owners, but if you work at a large employer, more than likely they have that opportunity for you. So here are the key takeaways. Roth IRAs and other Roth style accounts are accessible even to high income earners. Number 2, understand tax implications before converting and work with a tax professional for best results. Thanks for joining me today. If you want help building a tax plan that includes Roth strategies, visit us at www.tandvllp.com/tax-planning. That's www.tandvllp.com/tax-planning. Let's build tax-free wealth the smart way.